Hey folks, Dave Nadig here, financial futurist at VettaFi. Sat down with Cam Dawson, who is the Chief Investment Officer at NewEdge. Not only one of the smartest investors I know, but one of the best communicators about what's going on in the market. We talk about the CapEx cycle, we dip into options trading a little bit, we talk about how we moved on from a world where all we're focused on is monetary policy. I hope you enjoy it. I think it's a good setup for the next 6 months. Cheers. Hey Cam.
Good to see you.
Good to see you. We're sitting outside the New York Stock Exchange, which is on a beautiful New York day. I'm going to guess you were inside talking about what's going on in the world. Look, I get all these calls from advisors not understanding the current market at all. We just had this brutal 2022. A lot of people got really just chased out of the market. Now we've had this incredible rally that I know so many people who aren't participating in. I don't know anybody who got the 33% NASDAQ over the last 6 months.
Yeah.
So what should investors who are normal investors, not crazy speculators and not stick it under a mattress investors, what should a normal investor be doing in the second half?
Well, I think the first starting point is to kind of assess how we got here and why we are where we are. And I think you hit on a really important point, is that people gave up on the market in the end of 2022. We saw a lot of tax loss selling and positioning got extraordinarily light. And what we can see in different positioning metrics that you were deeply underweight. So what that created is an environment where people had to chase to get into this market. And we've been thinking a lot about why valuations can be so high and so persistent. And the reality is that when you are underweight, you may not care about valuation. You just got to get allocated.
You got to get exposure.
Exactly.
Right. Let's talk about valuations for a second. They're a little high. They're certainly a little high if we're thinking about a market with some problems. But the flip side is we're going into an earnings season, and I just looked at Conagra's recent report, and not only are they raising prices despite declining volumes, they actually think they're going to get major margin impacts on the upside by the end of this year. Is there a big disconnect between how normal people think the world is going and how companies with pricing power think the world is going?
I think that it's a fundamental misunderstanding about how inflation impacts earnings. Inflation is fantastic for corporate earnings. And I know it doesn't feel that way, but inflation does something powerful. It gives companies pricing power. And if you go back to all past the great financial crisis, every company just complained that they try to raise prices and people would dial back on demand. They had no pricing power. Today, even Conagra, look at Pepsi, they raised price 15%. And yes, demand is falling, volume is falling, but they're still pushing price. So what happens is when you have inflation, everybody will be more willing to accept higher prices. Higher prices, pricing power drives higher revenue growth. Higher revenue growth drives something very magical, and it's called incremental margins or contribution margins. So what you see is that there's a strong relationship with the pace of revenue growth and the margin level that we achieve, meaning that we reached a record margin in 2022 because revenues were growing 11%. And they're growing 11% because of inflation.
So how does that unwind? Because you can't just keep raising prices and destroying demand forever. At some point, you don't have a business anymore.
I think it's a little bit like the game where you take a bunch of rubber bands and keep putting them on a watermelon.
And seeing whether it goes pop.
And eventually you put that one on that makes things explode. That's a kind of where pricing is that you keep pushing, and eventually people start to push back and they really dial back on spending. And so we've still been in this environment that because consumers have jobs, they're spending money. And because they're still recovering from all the pandemic lockdowns, they're tolerating higher prices. Eventually excess savings will be dwindled down. I've seen estimates now it's as soon as September. So you'll lose that ability to say, you know what, whatever.
To heck with it.
I'll spend money.
I'll buy the computer. It
doesn't mean that spending will fall off a cliff. It just means that as inflation slows, pricing power will slow, revenue growth will slow, and remember, earnings are a nominal number. So lower revenue growth does actually mean lower earnings growth. And then you add in that margin dynamic on top of it. So that's where we're looking at 24 and 25 estimates for the S&P 500 that have margins going back up to an all-time high. And we go, okay, we see upside in certain places, but let's really kick the tires on that margin expansion to see if it's possible in a low inflation kind of world.
So it sounds like the setup is probably a pretty good third quarter for sort of just generally speaking in terms of certainly consumer type stocks. But then you're a little bit more concerned like going into next year. Is that an accurate way of thinking about it?
Yeah, I've heard a lot of strategists talking about sort of this, if you can't beat them, join them kind of mentality.
Well, that's sort of what it feels like.
I'm not betting against this right now. The fact is that there's strong momentum. You look at the technicals, you have expanding breadth, you go, I don't know what is going to upset this market at this point. What that likely creates is a continued chase higher. You can get more extended, more overbought, and positioning, which is now about 75% of the way from going deeply underweight to now being very, very overweight. Once you get to that overweight point, then that's where things can start to get hairy.
That starts feeling like momentum chasing at that point, right?
Exactly. And I was looking at the equity risk premium today, right? The idea of what's the relative valuation of equities versus bonds. And in the period from late 96 through 2000, equity risk premium was negative. And if you stayed out of the market just because stocks were expensive, it was the wrong call, which means that valuation can't be your only tool in deciding where to be. We have to have an outlook on where earnings are going to be. We have to have an outlook on things like liquidity, which we know has been a boost to markets this year. And we have to have an outlook on where we think policy is going to go. And if we're really going to get the deliverance of that easy policy that the market is now so resoundingly pricing in for 2024.
Right, not only easy policy, but soft landing along the way, right? Just like this Goldilocks ending that a lot of people seem to be setting up for. Do you think we're moving from a world where everything was about monetary policy volatility towards a world where we can care a little bit less about that and start caring about the real economy again?
I think that the first 6 months of trading has shown you exactly that, is that the Fed was the only game in town in 2022. Whatever the Fed did, that's where markets went. And you saw a very strong correlation between things like real interest rates and valuations for stocks. Those relationships have completely broken down this year, which means that you're still seeing high interest rates, and yet stock valuations are now back up to levels that you were in when the Fed was aggressively easing policy during the COVID boom. And so there has been this disconnect, which just means that there's something else driving markets. And that something else we think is positioning, going from underweight to overweight, as well as optimism around AI and the potential for what that could mean for earnings.
What about the options part of the market? Because that's another big question we've had. I have a webinar going up in a couple of weeks. I'm talking to Chem Carson and Mike Green about how the options market's skewing the equity market.
I'm going to get my tinfoil hat. I don't know. It's so difficult because it all happens with data that's hard to find.
And it moves so fast. Yeah.
But I would encourage people to go back to the summer of 2021 when we had a gamma squeeze. And the gamma squeeze is this idea that you have this sort of self-perpetuating machine in markets where buying of options creates more buying of the underlying, which kind of perpetuates and things get higher and higher. And what you can see is in the NASDAQ and a lot of the popular names that were part of that gamma squeeze, that they had kind of blow off tops and consolidated.
That's what you expect to see, right?
And as that unwound, of course, it unwound in much bigger magnitude in 2022 as that positioning was completely unwound. But I do think that there's probably some of that dynamic. The other thing I'd note is that a lot of the momentum we've seen in the markets really accelerated once we crossed the 4,200 level. That was the level that it was like Gandalf saying, "You shall not pass.
Thou shalt buy. Thou shalt buy."
You say, "You shall not pass." Like you will not get past 4,200. So you get past that level, all of a sudden everybody gets dragged into the market, and those are the CTAs who do the performance, who are kind of chasing the momentum.
And now all the momentum guys get in as well.
Yeah.
So it sounds like maybe the answer is, there's got to be some of that in there. We know that impacts markets. It tends to show up in blow-off tops in individual names, not in the entire index all at once, but also extraordinarily difficult to position against, right? I mean, the smartest options guys in the world don't have a perfect track record doing that. Sometimes they manage to nail it, sometimes they don't, but probably not a game average folks should be playing, right?
Yeah, and we just know how much it persisted in a time like 2020 and 2021, right? You could see these really crazy things happening in those years early on in 2020 with all these rip-roaring rallies in unprofitable companies. There was all this crazy options activity, but it lasted for 18 months. The thing that's different this time time and is so peculiar is that at that point, you could make sense of a lot of it because there was such a liquidity flood.
Also mid-pandemic, new dynamics, new people coming to the market, there were a lot of narratives.
There was all these things. And so when you have tons of liquidity, people clamoring to get in, new entrants, what's different this time is that it's not as if we've actually seen a shift in Fed policy. And so you're seeing that same kind of behavior. You saw an unprofitable EV truck company up 50% today that just had a lawsuit. And so you're not necessarily seeing the kind of liquidity that you would normally associate with this kind of market move. But, it's still happening.
Right. Well, before we let you go, what's giving you hope? Like when you're thinking about positioning your clients for the next year or two, what are you really hopeful? What's your high conviction? What are you like, this is going to work, this has got to be part of the portfolio?
Yeah, I think that there's some really interesting inflections that are being seen in our fiscal policy that is generating some investment in CapEx in ways that we have not seen in quite some time. Pull up a chart of non-residential construction and manufacturing. It is hockey stick higher. Now, a lot of that is the CHIPS Act, but what that does is it creates a CapEx cycle and an investment cycle moving higher. I think that there's potential for manufacturing to come back. We've seen a big inventory destock.
We've seen some of that. We've seen some factories being built. Like all those signs are pointing in that direction.
Yeah.
Sounds like you're a buyer. You don't think it's just the CHIPS Act and then it's all going to disappear.
Well, we've been in an inventory destock for about 18 months, and yet demand has remained much better than expected. So if demand continues to hold in better than expected, you're going to have to continue to reinvest in some of that capacity. Now, the question is, what does that mean for margins? What does that mean for what we've seen as the big trend that's been a boost to margins is globalization.
Right.
As that starts to fade, as we do more reshoring, the thing we're thinking a lot about is what is the incremental cost of that productive capacity. But we're seeing great trends in things like the building out of EV infrastructure. You're seeing great trends in the potential for AI adoption from an actual physical infrastructure side of things. But I think the thing for people to always remember is that sometimes you price all the good news in too soon. So we'll remain valuation discipline, even with these longer term mega trends, in order to be able to continue that compounding of value and not get sucked into those blow off tops.
The CapEx has been really interesting. I mean, it's been encouraging for me to watch because that's how you build a country, right? Do good CapEx, good building of infrastructure, whether it's a chip fabrication plant or whether it's a highway or a bridge.
Yeah.
Like those are real growth to me. Those are like what make us survive the next 100 years, not the next 2. Does that run into a wall in the labor market at some point? Because you can build a factory, but at some point you got to pay somebody to show up.
I think that is a really good point, which is that the promise that we're talking about of AI kind of releasing some pressure on the labor market is more on white collar and a lot less on blue collar. And I had the great benefit of getting to research the robotics companies in my career. I covered the industrials. I got to get to know the robotics companies. And these processes of something as simple as picking up a blue pen in a bin full of black pins is extraordinarily complicated. And this technology has been in progress for quite some time. But manufacturing automation does seem to be the answer to solve that problem, but not everything can be automated. And so I think that you do run into the issue of finding available labor. It speaks to the old kind of basic law of economics, which is that growth is labor plus capital
yeah,
plus,
that's my mind, right?
plus efficiency.
Right.
And so productivity. And so we do need to be able to solve for each of those things in order to be able to continue to have kind of above potential growth or lift that potential growth rate higher.
But it's nice to see some CapEx finally coming online. First time I remember in my career since the dot-com boom anybody spent money on anything but a server.
Well, I covered the industrials and I kept hearing about the great manufacturing revolution in the US and looking around and going, well, where is it? I don't see it. Right. But I think that raises an interesting point, which is that we look at the last 3 big tech cycles, internet boom, the personal consumer cycle, as well as the mainframe cycle, they all had huge CapEx portions of them. The internet boom, you're actually laying cable, you're buying computers.
All the fiber, oh my gosh, yeah.
All of this stuff was actually a CapEx cycle. That's what was so powerful. Right,
but that's the last time I remember one, was that.
And so will AI be that same kind of CapEx cycle? We know it is for NVIDIA. We know it is for some data
Taiwan
center
Semi is going to do fine.
They'll do fine, but does it have that same kind of broad multiplier effect like the internet did on the overall economy?
Well, thanks so much for spending some time with us today.
Of course, thank you for having me.